Hello, founder. You've built a successful business, and now it's time to think about that once in a lifetime exit from your business. You've come to the right place. Here, you will hear business exit professionals involved in the buying and selling of companies talk about what you should know before you exit. If you've never sold a business before, this podcast can be super helpful to you. I'm Armando, host of the Founders Guidepost. Enjoy. But first, a quick disclosure. Opinions expressed are those of individual professionals. The Founders Guidepost is provided by Axiom Founders Family Office, Inc., a registered investment advisor licensed or exempt from state registration in all states in which it operates. The Scottsdale Founders Forum is a biannual live event for the founder considering exiting in the next 5 years. More information available at scottsdalefoundersforum.com. If you like this information, please subscribe and share. Hello, this is Armando with the Founders Guidepost, here today with Delilah Panio of the Toronto Stock Exchange. Delilah, how are you?
I'm so great. It's really a pleasure to be with you here today, Armando.
Oh, fantastic. So, Delilah, a lot of companies in the US have these dreams of going IPO and going public. And many, of course, have never gone through that before. And they don't know what they don't know. They hire experts, consultants, et cetera, and they do their best that they can to reach that goal. But what I enjoyed so much about our conversation recently is that you are another avenue that exists that can help them reach that goal and reach that IPO going public dream. But I would venture to say that a lot of folks here in the US don't know that you're there and they don't know how you really can benefit them. So let's have a conversation all about that. And hopefully business owners who are thinking of going IPO will listen and they'll want to contact you. But today, let's have a good conversation just about how that can work for them.
Perfect. Yeah, this is exciting. So what we're really talking about is growth capital, right? And what are the different options in North America for growth capital, but specifically for US high growth companies? Like you said, they're looking to get to that ultimate exit of IPOing on a US exchange. And what are the different ways to get there? So let's take a step back. Let me just give a little bit of context of who I am and how I fit into this, because it seems probably strange that, why we're talking about Toronto Stock Exchange for US companies. So I'm the Vice President of US Capital Formation for TSX and TSX Venture Exchange. And I'll talk about our two-tier market in a moment, which is very unique in the world. But I'm actually based in Southern California. And so I cover the Western US, and certainly we met through our interactions in Arizona. And so, my job ultimately is to talk to US CEOs who are looking for that high growth capital to fuel the growth of their companies as they're trying to build, world-class scalable businesses. And what's interesting to me, as I represent the Canadian capital markets, is that there is clearly a gap in what the US markets and how they're serving some of these companies. So, at the end of the day, why are US CEOs of great growth companies talking to me about going public in Canada? And I'd say that there's a couple reasons for that. If you look at the landscape of the North American equity capital markets, right? And so if you look at the private capital options, so you have starting from, angel investors to venture capital to private equity, all the way up leading to a potential IPO on a senior exchange like New York Stock Exchange or NASDAQ. And then you have the public markets where, again, as I mentioned, NASDAQ and NYSE, which you can go public at an earlier stage, but, are you relevant enough for that marketplace, right? And then below that, you have the OTC over-the-counter markets. Again, this is they are not regulated stock exchanges. They are an over-the-counter market, which does serve a lot of early stage companies and public companies in the US, but not in a regulated way in that we do in Canada. So I would say that that's the first kind of thing to think about, is that if we're looking at this whole ecosystem, if you are raising that sort of Series B plus capital, that's really where we come in, Armando, is in the companies raising their Series B. So let's call it, the amounts change, with the trends every year, but let's call it that sort of $10 to $15 million capital raise. You've done your friends and family round. You did your pre-seed, your seed, your Series A. All of that typically is development capital, right? Where you are accessing those pools of capital to develop your company, develop your minimal viable product, start developing your markets. So once you're past the development stage, you're in market, you have early customers, and now you're looking for that explosive growth capital, right? So now you're looking for that much bigger, like I said, a 10, 15, 20 million dollars, and you're looking at now that capital that's going to take your company to the next level, typically, in that sales, marketing, opening, distribution to several markets. You've already have your proof of concept, but now you're really to like get out there and really sell. That's where the public markets, especially in Canada, start to get interested in these companies. So I'll just pause here if you had any questions about that, or I'm happy to continue on, or any thoughts on that.
Yeah, so I'm glad that context is extremely, extremely helpful. So if people have been looking and thinking they're going to go on the NASDAQ or something here in the US, and they want to make their footprint larger, they've got to have metrics and traction, revenues, all those things that make them a good IPO candidate. If they aren't aware of the TSX and how you might be able to help them get that, why would they want to go through Canada first to get to the US markets?
Yeah, that's a great question. And actually what you just hit on is really what our value proposition is for US companies, right? So let me give you an overview of what the Canadian capital markets look like, and then therefore the relevance for US companies. And as I said, what our value proposition is for the right kind of company. Okay. So uniquely in Canada, TMX Group, which is the company that I work for, owns and operates Toronto Stock Exchange and TSX Venture Exchange. And so TSX is, a typical large cap marketplace for public companies. The average market cap is, depending on the markets last year, different than this year, obviously, but somewhere in the, around the $2 billion range for average market cap. Again, relative to the U.S. exchanges, still pretty small cap, and that's what we're really great at in Canada, small public companies. But then uniquely, we have something called TSX Venture Exchange. So this is what we call one of the only regulated public venture capital marketplaces in the world. And so what does public venture capital even mean? It means that what people would normally think of for raising their venture capital to get to a big IPO in the US, you can actually go public instead and access those venture capital rounds, those Series B, C, and D in the public market instead of through private venture capital or private equity. And so, why would you think about that? Why would you do that? So there are several reasons, and the biggest one is ultimately it's around control, right? So private venture capital and private equity, are obviously significant forms of capital for the right companies. They also come with very specific terms that can be potentially egregious to to the founders of the company. Whether that's preference shares, liquidity preferences. When you start to get past Series B and C, as the founders of the company, you are no longer really controlling your company, right? Because they are now, rightfully so, they're investing the money into the company, so they are taking higher control of the company. If you go through the public venture capital market, like on TSX Venture Exchange, you actually can maintain a lot more of your control of your company for a lot longer. So, for example, on TSX Venture, you only need to float 20% of the company with the public to list on the market. So again, if we look at an example of a high growth tech company, they're raising $10 million, they come to our marketplace at a reasonable valuation at, let's say, post financing, 50 million. So that's 20% is owned by the public, but the other 80% is still owned by the initial shareholders of the company, right? Or whoever the investors are. Yeah. So, and the big difference is that everyone's a common shareholder, right? Unless there's a unique structure around multi-voting classes, but typically when you go public, everyone is a common shareholder. And so that means that, you are still controlling, the destiny of the company. So I would say, again, so on the TSX Venture Exchange, the average market cap of the companies are more in the $50 to $100 million market cap range, right? So these are very early stage, higher risk, but higher potential reward companies. And we have a 170-year history. We just celebrated our birthday a few weeks ago of Toronto Stock Exchange. And our history, not surprising to most people who think about Canada, was built on, mining and oil and gas exploration companies. So, decades ago, those companies that were high growth, that were sort of really fueling the economy in Canada, needed to go to the public markets to raise that really early stage pre-revenue exploration capital. And we in Canada have just never had the significant private capital that exists in the US, right? Which is where all the venture capital funds come from, the private equity funds come from. So in Canada, we have always used the public markets for those really early stage emerging growth companies and emerging growth sectors. And so we built a significant global marketplace, especially in mining, where we still are the #1 mining exchange in the world. 50% of all dollars raised in mining goes through our market. So we have a significant franchise in mining and in the energy sector. But in the last 20 years or so, we have significantly diversified our stock list by the attraction of innovation companies. So whether it was technology companies, life science companies, obviously everyone knows about the cannabis boom that we had when we were listing cannabis companies, Canadian companies, psychedelics, cryptocurrency. There's an investor base in Canada, especially on the TSX Venture Exchange, that is very interested in those emerging sectors, the momentum plays. One thing to really think about on any marketplace is who are the investors, right? And so in Canada, we have investors from all around the world. About 40% of the trading comes from outside of Canada. But we have a very robust retail investor base in Canada, which is what really fuels these early stage companies. And because it's on a regulated market, there's a bit more comfort for companies coming to our market. So again, we have this really unique two-tier market of TSX Venture for very early stage companies, and then TSX for later stage companies. And so when we talk about the value proposition for US high growth companies, you can, if your goal is to get to NASDAQ or New York Stock Exchange, let's say in the next 3 to 5 years, you're sitting here raising your Series B, let's say it's 10 to 15 million. And you have options. You can look at, okay, I'm going to go down the private venture capital route to get there. And that's a well-worn path, obviously. Or uniquely, you can look at coming to our market. And here's what that could look like. So the company, if it makes sense from a going public perspective, and we'll dive into that in a bit too, in terms of why you should even go public. And so starting on our market on TSX Venture Exchange, raising, your Series B capital at a reasonable valuation, doing subsequent, hopefully non-dilutive rounds of capital on our market, executing on your business plan, reporting on building revenue, et cetera, building your markets, and graduate to Toronto Stock Exchange. And then at that point, the difference is it's higher liquidity in trading. For most companies, you are likely getting higher analyst coverage, more analysts looking at your stock, and you are likely getting bigger institutional money coming into your stock. So that's the difference between venture and TSX. And then when you're big enough and relevant enough, and this is really the key word, relevant enough, you dual list onto New York or NASDAQ. So your end goal is still getting to the senior exchange in the US, but your path to get there is different. And what's brilliant about this path as well, coming to our markets, is that we actually have an agreement between the two countries, something called the Multi-Jurisdiction Disclosure System, MJDS. And what that means is if you have been trading on TSX or TSX Venture for 1 year, then you can, and you apply to NASDAQ or NYSE, then you can use your disclosure documents that you've been filing for a year as a public company in Canada as part of your application. So you don't have to redo the whole S1 and all the time and costs that come with it. The US exchanges will take your disclosure documents as part of the application. So that just saves a lot of time and money. And there are a significant number of companies that are dual listed. Last year we had a record, about 45 companies from our market, TSX or Venture, dual listed onto New York or NASDAQ. This year, I think we're probably around 20 or so. And so every year, so it's a well-worn path, right? That companies are looking at more and more, and including from the US.
Wow, fantastic. Fantastic. So last year you said 2021 was a record, 2022 a little bit less, but obviously there is reason why people are going through the Canadian markets first. I like what you said about maintaining control, where you don't have to give up or give away all the company, but you've got to give up, maybe you said about 20%. But the owner,
To start, yeah. And then you, obviously the more capital you raise, you're issuing more shares around that. But the key again is that they're common shareholders, and so you don't have the preference shares that you have with taking venture capital. It's also permanent capital, right? So it's just a different form of capital.
Mhm.
But what I'd love to do is talk about, how do you even think about going public if it's even right for you, especially at this early stage? Because again, in the US, the mindset is you have to wait to be a really big company, like $1 billion company, to go public reasonably, right?
Right.
And that's fair, because even though there are a lot of companies that go public earlier, it's very difficult to maintain the share price, et cetera. Like, for example, on the senior exchanges in the US, if you're a small early stage company, it's really difficult. Look at the companies that listed last year in that high valuation year, and then this year it's going to be more challenging to maintain that share price. So I would predict there will be a lot of delistings, in the next year or so for those companies. So again, you want to be looking at a marketplace that's relevant. But let's even just step back and think about, okay, if you are a CEO, a founder of your company, you and your management team are thinking about again, looking at the landscape of options from my series, let's say my Series B capital. How do I think about going public, and if it's even right for me? So I've coined something called the 4 R's, which are just easier to remember information. And I think you saw my presentation back in October that went over it, but I think it's really helpful to really get into the mindset really of the founders. It's like, okay, the first R is reason. Does this company have a reason to be public? So most companies, as we know, should not go public, right? And most US companies should not go public in Canada. So it's how do you know if you're the right company that this makes sense compared to all of your other capital raising options? So starting with reason, do you have a reason to be a public company? So this would be true of looking at going public on any market, not just our market. So would this company benefit from being a public company? And so what are those benefits? So obviously the number one thing is access to capital. In theory, the public markets are unlimited. You can go back, to the market, assuming you're, again, executing your business plan, et cetera. So access to capital, ongoing, in theory forever, right? Permanent capital again. Acquisition currency. So this is probably the number one reason why most early stage companies consider going public at an earlier stage, is because if you are a public company and can use your stock as currency to make acquisitions, and you have an aggressive acquisition strategy, then that can be significantly less expensive than having to raise private capital to make an acquisition, right? So today, if you were a decent public company, and there's a lot of inexpensive companies to be buying right now, right? It likely in your vertical. And so if you are public, that could be an easier way and less expensive way to grow your company, not just through organic growth, but through acquisitions. So that's another big one. Another one is just exposure, being, when you go public, even on a junior, earlier stage on TSX Venture Exchange, you have gone through a vetting process. Someone outside of you and your investors has looked at your company, whether it's the investment bankers who take you public or the TSX Venture on the listing staff. We have looked at your company. We have validated that it's a real business. You have to have audited financial statements. So there's real information here. So if you are a growth company that's looking for that credibility that you are real and that your numbers are real, being public can give you that credibility, even at an earlier stage. Another benefit, a reason to be public is, again, like I talked about earlier, diversifying your shareholder base, right? Is to have clean up the cap table. Everyone's a common shareholder, diversifying. So it's not just one or two that are controlling the interests of the company. And then the last really big reason why a lot of companies go public is for incentives for their employees, to create, stock option plans to reward employees by giving them a real path to liquidity, versus if you're a private company and you stay private really like much longer than probably intended, your employees are not benefiting from that. Like there's no exiting, they can't sell the shares. Whereas if you're public, and you're getting stock options along the way, you might be able to to liquidate some of those shares and do things like buying houses and paying off student debt and all the reasons that people really want to benefit from the growth of the company that they're participating in, right? So from a reasons to go public, every founder should think about, okay, what I benefit from having all of those, realities, whether it's access to capital, acquisition currency, stock options for employees, diversifying shareholder base, credibility. So if that makes sense, if after a founder has thought about that, talked to their shareholders, it's like, yes, we would really benefit from being public and earlier than what we thought. So that's the first one. That's the first R, that's reason. The second R is ready. So are you ready to be a public company? It's a big deal to be a public company on any market, even at an earlier stage. And so what does that mean? What does readiness mean? As I mentioned, you need at least 2 years of audited financial statements to be on TSX Venture. So that can be a big deal for a lot of companies, depending on their financial systems, getting things audited. But I will also say it's easier to do when you're a younger company than later, right? And so there's a discipline that happens when you go public. So thinking about, are you ready to have internal controls and having more disciplined financial management of the company? Again, that can benefit a lot of companies. Think about some of the companies that have blown up later, that if they'd been public earlier, that some of that stuff wouldn't have happened because they had the discipline, right? So that's a big one, the readiness around audit financial statements, internal controls. We're gonna, is your management team ready? Do you have the right CEO? Do you have a CFO with public company experience? And this is where often you'll see the founder, that might be the scientist or, the data person or the product developer, steps aside so that a public company CEO can come into place, because it's a different game. And when you go public, you're literally running two businesses. You're running your company and then you're running the public company. And so in the readiness bucket, you have to be ready that the CEO's time will be significantly taken away for investor relations. So, once you go public, that's just the beginning, right? You have to have continuous sharing and communication with your investors, current ones, and then always exploring for new ones, right? So who's running the company when the CEO is doing that? So in that readiness thing, you have to really think about that, of who's running the company. And then probably another thing with your board of directors, you're going to move from a advisory board, private company situation to a public company board, where those board members now have very specific, fiduciary and legal obligations. And so are you ready to move into that kind of a scenario where you have a public company board? And then probably the biggest one on the readiness side that causes a lot of companies to pause, as it should, and a lot of companies to not go public, is transparency. So you are now, all your business is out there in the public. Your financial statements are in the public, your strategies in the public. And for most companies that are growing, that's not a positive thing because you're pivoting, you're making mistakes, you're doing all of that. But for the right company, it's actually a brilliant thing, because again, it causes that discipline for you to create a company that can be open to transparency. And I'd also say that depending on what sector you're in, sometimes we've had a lot of companies, had one recently that their next competitor is a big public company, that if you look at them financially, that their competitor, they're not doing that great. But the private company, their information is not out there, right? And so actually that company looks better financially and as a better potential, for their customers. So sometimes, customers will look at, if you're a public company, they're looking at you too, right? And if you are a good, healthy company, it can actually benefit you, that transparency. But that is a really big one that most companies really, get stuck on. I'll maybe see if you have any questions there before I move on to the third or fourth R.
No, keep going. I love I love the information that you're putting out there. And I just think that it's so extremely helpful just having you explain it and walking through what it really means. Thinking of exiting your business? This may be your once in a lifetime opportunity to preserve your American success story. I invite you to come to the Scottsdale Founders Forum, a biannual live event for the founder considering exiting in the next 5 years. More information at scottsdalefoundersforum.com.
Okay, good, perfect. Okay, so we did our number one was, do you have a reason to be public? 2 is, are you ready to go public? 3 is requirements. So do you meet the listing requirements of the exchange that you're considering? So one of the things I'd love to share is that the difference between the listing requirements from, say, NASDAQ or New York Stock Exchange compared to our listing regime. So in the US, the exchanges, their listing requirements are based on things primarily on market cap, share price, shareholder equity. In our market, our listing requirements are based on the financial fundamentals of the company. So for example, we're looking at things like revenue, net tangible assets, working capital. So these are, especially, revenue, NTA, these are factual numbers, right? You can't manipulate the numbers, you can't shift the numbers, you can't sort of bend yourself into those numbers. They are what they are. Whereas, market cap, share price, et cetera, can be adjusted, can be manipulated, depending on timing and just agreement of all the parties, right? And so on our market, especially on TSX Venture Exchange, because we list pre-revenue companies, how do you look at valuing those companies, et cetera. But the key is we want to make sure that the investor base knows that these are real companies and that they are, saying what they are saying is true. And so we're looking for those like real factual numbers like revenue, NTA, R&D spend, et cetera. And then for the pre-revenue companies, so what happens if you don't have revenue? How do you come to our marketplace on venture? And that we're looking for working capital. And so what that means is when you apply to TSX Venture to list, we will ask for your business plan and you will say, okay, to keep the lights on for the next, let's say 18 to 24 months, we need $10 million. And here's our business plan, here's our budget. We will review it, we will agree with you. And then the condition to listing on TSX Venture is that you have to raise that amount of money to have that working capital in your treasury on the day that you go public. So if you say that you need $10 million, then either you have the 10 million or you have to raise that 10 million in your treasury. And that also helps us to know that the public is interested. Like if you can, as a pre-revenue company, you can raise $10 million, when the public is interested in your company and they want to be part of your opportunity. So that's kind of how that works out in terms of our listing requirements. But again, very, very different regime than in the US. And we have, and I'll share with you, or somehow you can share, in the show notes later, our US website, which is us.tsx.com. And in there is our guide to listing, which very clearly shows everything I'm talking about, including the 4 R's are all in there, but also the listing requirements. And you'll see what's unique is there's a matrix. So if you're a pre-revenue company, if you have revenue, then you meet this category. If you don't have revenue, then we're looking for this and this and this. And so it's a little bit of a matrix. And the point of that is we really want to help companies access the public markets if they're the right fit. And so we will do what we can from our listing requirements to fit you in. And again, if there's investor interest and that kind of capital is being raised, then we want to do our best to help that company get listed. We're very, very customer service oriented. And because we ourselves are a public company as well, TMX Group is listed on TSX. And so we're very interested to help our companies, and we understand small micro cap public companies. We've been doing this for a very long time. And so there's this infrastructure that has built in Canada over that time where the securities commissions, the exchanges, the investors, both retail and institution, the analysts, everybody gets really small public companies. And what's interesting, because we have this very robust retail investor base in Canada, where most of us, back when I lived in Canada, even my retirement money is being invested into very early stage companies, but there's an opportunity to invest in to basically be like a venture capitalist, right? Like you're getting in on these deals that you would never get to see in the US. And that's exciting, whether it's a mining or crypto or a tech or an ad tech or clean energy now is obviously going to be a massive sector in the new years. So that's the third R on requirements. Any questions on that?
No.
All right, well then let's go to the last one, which is like the
a lot out there.
What is the fourth R, right? Okay, so here's the thing. You can have every reason to be public. You can be ready to be public. You can meet our listing requirements. But what is the reality of your company getting financed in today's market? So the fourth R is reality. And what does that mean? Can investment bankers or brokers, basically sell your deal today to their investor base? And that is what changes all the time, right? Last year, the companies were talking to very different conversation than this year. Last year, many companies could go public and did go public. We had like in the US, we had a record year on TSX for listings and graduates from venture to TSX and dual listings. And in the US, we had a record year of US listings. We had 25 US listings last year. Typically, we'll get 10 to 15. This year, even in a down market, we're still going to be closer to 20, but very different conversation than last year. So, last year, what was driving the new listings was definitely the innovation sector in, technology, life sciences, lots of different kinds of companies were listing last year, like in the US. This year, obviously, as we know, both the IPO market in both Canada and the US has basically been closed. But because we have on the venture exchange, you're listing more through a reverse merger into a clean shell, which is our capital pool company program, CPCs, which are similar in essence to SPACs, but very different in terms of the reality, because SPACs were true acquisition corporations with billions of dollars in them, and we saw what has happened obviously in the SPAC world, where 80 to 90% of all the funds raised there was a redemption of those. So even if you end up listing through a SPAC, you have to still go and do a raise, a pipe, versus because that money wasn't in the treasury when you listed. And then there's just been a lot of issues around the SPACs, a lot of lawsuits, a lot of issues. And but in our market, the CPC, the Capital Pool Company Program, so these are basically in essence mini shells. So what it is 3 to 5 people get together, put in their seed capital, and then go to the public and raise up to 10 million. So these are the maximum that are in these shells are $10 million, but they're clean. They're only, there's just the cash and the directors. That there's no previous operating history. And then those companies like a SPAC then have they go out and look for a company to take public, and it's really more of a listing vehicle versus a financing vehicle, because again, there's only up to 10 million, but most CPCs have closer to around 1 million or under 1 million. So why would a company do that, right? It's because they want to access the public markets. They're only raising, let's say, $10 million, which they can raise through some family offices like yourselves, or a few institutional investors and some retail. But you need to have those, those 200 shareholders to list on our market, right? On the venture exchange. So the CPC has 150 minimum shareholders in it. And so you're using that shell, the listing vehicle. It's also a Canadian C Corp. And so, one of the considerations of listing as a US company is that you may want to, be deemed a foreign private issuer in the eyes of the SEC, so you can delay registration with the SEC and therefore delay, compliance with Sarbanes-Oxley and some of those, the SOX, all the bigger, high-priced, realities of being a small public company in the US. And so In Canada, we have what we call right-sized corporate governance. And so if you are listed on TSX, you're basically complying with SOX-like compliance. But if you're on the venture exchange, we have some carve-outs because we understand that small public companies need a break. So whether that's allowing more time to do your quarterly and annual filings, there's no SOX 404 equivalent, which is the audit of internal controls, which is very expensive. So we really understand small public companies, so the corporate governance is different. So you could, and many companies do, US companies, have a US or have a Canadian C Corp as a holding company, and there's structures around this that you could become a foreign private issuer in the eyes of the SEC. And then going through a CPC is one way to do that because it is a Canadian C Corp. So that's a little bit about ways to list on our market. You can do an IPO, you can go through a CPC, you can do a traditional reverse takeover through an existing shell. So we have, the point is we have several ways to list that are conducive to being a small company coming to the market for the first time.
Okay. And you talked about costs and fees. Sarbanes-Oxley, of course, very expensive, very intensive to get that addressed. What about, can you talk about the costs? So somebody going through the US markets expects a certain level of costs with the audited statements and everything else that has to happen. What does that fee structure look like? How does it differ going through the Canadian market first?
Yeah, absolutely. So I'm going to give you some averages. Obviously, it depends on the readiness of the company and the structure, et cetera. But on average, for a company listed on TSX Venture Exchange, and these numbers include the things like the legal fees, and you're going to need Canadian securities lawyer as well as your US securities lawyer, your audited financial statements. So again, that can range depending on how ready you are for an audit. So if you think about legal fees, auditing fees, our fees at the exchange, investor relation fees, which are required, it does not include the broker dealer fees or the investment banking fees, which are similar to the US, that 5 to 8% of any capital raise. So if you take that part out and it's just the actual, the other fees, then on average, you're looking at 300,000 to 500,000 Canadian. So if we call it, 250 to 400 US, that's like all in listing. And then ongoing, you're looking at, somewhere between, 100, 150, 200, ongoing. So there's a big difference in cost, right? So in terms of just the cost of the fees that are in Canada versus in the US. And then the other thing that really that US companies need to think about, especially if they're thinking about going public in the US at an early stage, whether they're on OTC or early NASDAQ capital market, one of the biggest things is D&O insurance, right? And so D&O insurance is very expensive in the US because the US is a very litigious market, right? I mean, it's just a litigious country in general. And so, if you own one share of a public company in the US, you have the right to cause a lot of havoc. And unfortunately, that happens. The level of shareholder activism in the US, especially for early stage companies, is really, really high. And so that impacts the cost of your D&O insurance. In Canada, we have British law. So what that means is if you bring a frivolous lawsuit to bear in Canada and you lose, you pay everybody's fees. So it's a significant deterrent from bringing a lot of lawsuits. And so what that means is that the D&O insurance is way more reasonable because they're just the likelihood of shareholder activism in Canada is much, much, much lower than in the US.
Okay. Yeah, we are a very litigious country in the US.
I know it is what it is. Yes, yeah. But it has an impact, yeah, for sure.
Okay. And you said ongoing costs as well. So there's cost to, of course, go through the process, but then ongoing costs year to year after that are also.
Yeah, because you have every year you have auditing costs, legal costs, structuring costs, our fee again every year. We call it sustaining fees. You pay a fee to the exchange every year, and then one of the costs that needs to be considered is investor relations. So it's really important, to have an ongoing communication strategy for current and new investors. And there are all kinds of types of investor relations, whether that's doing roadshows, doing events, doing online. There's some good, there's some not so good. There's a lot of different things, but you have to, as a strategy, look at all of the different ways, because it's always interesting to me how companies come to our market and then they complain that they have no liquidity, but then they don't do any investor relations. We have 3,000 public companies in Canada. How do you get noticed, right? You have to be out there talking. You have to be at the events, at the roadshows, talking to retail investors, talking to institutional investors. And you need, ideally a sophisticated investor relations strategy. So typically that's somewhere, at least 10,000, a month, for decent IR. And you're looking at cross-border, right? You're looking at in Canada, you're looking at the US, because you obviously want your US shareholder base to grow as well.
Okay. So let me describe a situation I heard a business owner talk about recently, and let's say that he wanted to go through Canada to go through what we've been talking about for his own business. Mm-hmm. So he's in the medical device space, and he thought that his company had a certain multiple, that he was going to sell it, get that multiple, take the money, roll it into his next business, whatever that next business is. But he, along that process, realized that if he increased the size of his footprint and bought other smaller companies that were in his same space, and then his company itself became larger through those acquisitions, that rather than get that multiple, which might have been a 3x multiple, he could maybe get a 6x multiple. And so that became his goal, and that became what he began to work towards. So assuming that he met the requirements in the Toronto Stock Exchange to list there, assuming he met those requirements, how might you facilitate and help him reach his ultimate goal of having a company that is worth more, that he can sell for more and net more at the end of the day?
Yeah, so a few things on that. Like, again, multiples are always obviously a key metric, and that changes all the time, right? And so like what the multiples were last year, private and public markets, what they are this year, are very different. I think that often the private markets will offer higher multiples, but I think that we're now, like, we're seeing like those are coming down too, right? We know that the public market valuations are down significantly. That's obvious. From almost every company is down 70 to 80% from a year ago. But in the private markets, they're coming down as well, as VCs and private equity guys are looking to, like, how they do follow-on funding, for their companies, and at what valuations, right? And what's going to get funded next. And so it's always, as I said at the beginning, it's always important for the founders to know all of their options so that they can make an educated decision about, okay, I know what I can get in the private market, what can I get in the public markets, right? So, but at least have that conversation to find out. And so, my role in helping to facilitate, and I, by the way, I have a colleague in Chicago and a colleague in Dallas, so we're Team USA covering the US. And so it's coming to me, showing me your deck, looking at the financials, and really talking through your goals, like where do you want to be in 3 to 5 years? If you just want to sell your company a couple of years, then don't go public. I mean, it's way too much time and effort, and it's not the right thing. Not to say that you can't go public and still get bought, because I can tell you there's a lot of inexpensive public companies right now that are being taken private for sure, and that will likely continue to happen into the new year. But if you are looking, again, your goal, talking to me, should be to get to NASDAQ or New York Stock Exchange in the next 3 to 5 years. And we are one way to get there. And how I help facilitate determining if it's the right choice for you is by introducing the company to the capital providers in Canada. So whether that's to CPCs, and I think you met a couple of those when we were in Scottsdale a couple weeks ago, that are looking for deals, that they have their CPC ready to go. I introduce them to retail brokers who can also provide a lot of that financing opportunity on the raise, and then Canadian investment bankers who ultimately take the companies public. And so it's important to explore, and if it's the right time and the right fit, and it can make those introductions, and there's interest. We actually have a deal portal as well at TSX where we put all of our prospects on there, and then CPCs and bankers and brokers can look at those companies. And if they're interested, then I make those introductions, and then I help facilitate all those introductions, and including to advisors, whether it's the Canadian lawyers or auditors as well, so that a company like the one you're talking about, this medtech company, can get some, intel to see, oh, maybe I can get a better multiple in the public markets. But it's also just not about the multiple; it's about the growth strategy. Again, would my company benefit from being public? Can I make those acquisitions if I was public? And with the credibility and everything, help me to raise the capital I'm going to need for the next 2 to 3 years to ultimately be able to get onto NASDAQ or New York.
Okay. And so when they're going through this process, you're obviously talking with them to help them understand, like you said, the 4 R's that you have. Are they ready, and do they meet the requirements, et cetera? And I imagine sometimes you might tell them, you're really not ready yet. Go back and do X, Y, Z. Go work on X, Y, Z. Come back in 6 months, 12 months, and let's have another conversation.
Yeah. Yes, exactly. And the thing about, what I'm doing today, it's a very long process, right? And so companies that are listing now, we've been working with them for 1 year, 2 years, I mean, it's the practical reality of a company I talked to today with the time they start trading is because of all the things that they have to do to get ready, and then just market timing, right? I mean, there were a bunch of companies that were, ready to go public this past year, and then the market timing just didn't work, or their sector fell out of favor, which happens, right? Or they realized this wasn't the right timing for them. And so it's really important to start the conversation. Everyone saying to me like, oh, well, no one wants to talk about going public now because of the current markets, but this is the best time to be thinking about going public, because you want to be ready when the market opens, whether it's 6 months or 9 months or 12 months from now. And you don't want the market to open and then you're like, oh, I don't have audited financial statements. It's going to take me 3 months to get that, right? So this is the time to be exploring, to talking to people like me, talking to Canadian capital providers, getting ready, and talking to the exchange, so our listing staff, about any potential pitfalls or bumps we need to sort out now. So now is a good time to be preparing, or at least exploring, which market should I go public? What do I have to do to get public? And that's the work that I do with the company.
Okay. And that makes a lot of sense, right? The timing to go public has to be right to get the optimal, the numbers that you want. And if it's a depressed market, maybe waiting, preparing, getting ready, so that when that time comes back, or the time is right, then you're ready to go at that moment.
Yeah. And I'd also, invite companies, especially in the US, who might not have the mindset of, going public at a reasonable valuation, including in these markets right now, because then you have way higher chance of going up, right? And so again, if listing on our market is not a liquidity event, it's a growth capital event. So you are coming to our market on TSX Venture, you're going to be escrowed because you're early stage, as you should, and you want to come in at a reasonable valuation to be able to go back to the market at subsequent non-dilutive, rounds of capital, so that when you do get up to NASDAQ or New York, you have done it in, if you list this year, there's a higher chance of you doing this, right? Going up in the next, few years. If you listed last year, now you're here, now you got to go back up again, right? And that's a hard path to take. And so I talked to a lot of CEOs, and it's really difficult being a small public company, which is why you have to have the right reasons and be ready to do it. But this is, I encourage any companies that are thinking about in the next 6, 9, 12 months that they would like to be looking at the public markets, that this is the time to look at it.
Okay. And another situation, Delilah, I spoke with a business owner here recently who told me that, well, they launched themselves right around 2008, just before 2008. Then 2008 came, it really knocked them down. They really had to rebuild and rebuild and rebuild. And it's been a long path to get here to 2022, where now they've got about 10 million in gross revenue, taken a lot of time to get there, but now they feel like they're back solidly on their feet. And they mentioned specifically, they're not really looking to sell and have an exit, but looking to get some money to grow and put into place what they need, so they can really fill in those gaps as a company to then either maybe then have an exit or maybe then partner with somebody. But it sounds like where they are today would be a ripe place for you to have a conversation
Yes.
with them
Yes.
to see
Yeah.
where that might go.
Yeah, because again, this is TSX Venture is not an exit, right? It's a growth tool to get you to an exit later, right? And so, and even just the fact, like I said, like on TSX Venture, when you list, the management team and the insiders will all be escrowed, so they can't exit if they wanted to. Now it's a timed release escrow, but because we're saying to the markets that these are earlier stage companies, they're true venture deals, and so we're going to make sure that they don't just go public and dump their stock, that they're in it for the long haul as you are coming in at the high risk stage, right? And so that's why our market does work like that, is because it's not not thinking about TSX Venture as an exit or liquidity event, but as a true growth tool, to grow. And we have several companies on our market, that listed in the last couple of years, have been public for a long time. I know we have a podcast as well, and maybe we can put that link in the show notes maybe as well, where my colleague George and I, we interview our US CEOs and talk about, like, why in the world, as a US CEO, would you go public in Canada? And we had some really, really great conversations. I know my colleague, we're just about to release one by the Real Brokerage out of New York, and they're dual listed on NASDAQ, and they've had a really, really great story. And a couple other ones, like Edge TI, they listed a year ago, and I interviewed the CEO and the private equity primary investor, and why they brought it to our market. So yeah, there's some really good conversations for people to hear, not just listen from me, but actually from CEOs who have done it.
So, Delilah, another question for you. Somebody whose ultimate goal is to go IPO in the U.S. markets, but they're going through Canada to get through you to get that growth capital. How long would they be there before they would try to get to the U.S. markets? Then is it a 2-year, 3-year, 5-year?
I mean, it totally depends on the trajectory. We've had everything from under a year to several years, right? So it really depends on the sector, the trajectory, the relevance, to the U.S. markets. Like, let me put this in perspective. If you are a $1 billion technology company trading on, in the U.S., you're like 425, right? Like, that's how many companies that are bigger than you exist, and you're a $1 billion tech company. If you're a $1 billion tech company on TSX, you're more like 25 or 26. So that just means you are a much bigger fish in a smaller pond. And what does that mean? That means institutional investor, means exposure, means analyst coverage. So if you're like 400 and something in the US and fewer people, and I'm talking about $1 billion company. So now imagine if you are a $100 million tech company or a $250 million tech company in the US, what number you would be, and therefore what limited interest you're likely to get because of your size. Whereas in Canada, that you're still, you're going to be much higher up on the list, and so you're going to have more exposure to investors and analysts.
Okay, so Delilah, what have we not talked about yet in this conversation that's relevant that maybe we haven't touched on?
I don't think anything. I mean, we could talk a bit more about, I guess, maybe case studies, but again, you can go to our website, us.tsx.com. You can definitely download our guide to listing. It has a lot of this information in there, a lot of questions, and there's actually a full-on checklist. So if you go through that checklist and it doesn't scare you, and you're still like, this is interesting, yeah, that's when you reach out to me.
So let me just summarize a couple of things that you mentioned. Okay. TSX is for really growth capital, not exit, but for growth capital. It's another means to get that capital to grow the business, correct?
Yes. Yes.
Okay. And a couple of things you said that another plus is that the owners of the business, investors, they can maintain control. They don't have to give up so much so fast. So they can continue growing, get that capital without giving up so much of the monies. You also said the TSX Venture is really for pre-revenue. Is that right?
Well, it can be. We do have a list of requirements for pre-revenue. Obviously, in these markets right now, it's harder for pre-revenue companies to list. Right now, most of the markets are looking for revenue, proof of concept companies. But we have a listing regime that allows for pre-revenue companies to go public.
Okay. And the companies you said $50 to $100 million
Yeah, market cap like on TSX Venture. Yeah, TSX is more in the $1 to $2 billion range. Yeah.
Okay. And the CPCs exist, of course, as a means, or they've got monies. They're looking for companies to work with to go through the Canadian markets, correct?
Exactly. Yes.
Okay. And then you had your 4 Rs. You talked about the 4 Rs and them being, do you have a reason to go public? Are you ready? Do you have the right internal controls, financials, audit statements, the right team in place? Do you meet the requirements and the fundamentals for revenue, et cetera? And reality, what's the reality that your current people can raise the money that you need, that you think you need to really grow this business? And if that reality is there that they can raise it otherwise, then maybe this isn't the best choice. But if not, at least have a conversation and consider going through and having a conversation with you. You also mentioned the costs, that the cost can be quite a bit less to get there, to get that extra growth capital they might be looking for. Whereas if you go through the public markets in the US, it can be quite a bit more expensive. And you mentioned specifically Sarbanes-Oxley, which of course has a lot of requirements and a lot of expense attached to it. And that you don't really have to go through that going through the Canadian markets, because Sarbanes-Oxley, of course, is a US public company thing. And then investor relations, you've mentioned a few times, and you mentioned also liquidity in that same breath, that investor relations in Canada, it's really important that is part of the budget. And that being part of the budget, so the investors the investors know that your company is there, what you do, why you do it. But so you're doing it sounds like your own PR for the investors, so they really understand who is this company, and that will help create the liquidity if there's some desire for liquidity in some of that stock.
Exactly.
Is that right?
Yes, that's right. Yep.
Okay, good. And anything, I know I touched on only a few of the things that you mentioned, and thank you so much for sharing so freely the information that you have. Anything that I didn't touch on that really is something that really needs to be drilled home for the listener who's thinking about getting that growth capital that they so badly want for their company?
Yeah, I would just say that every management team, every founder needs to be looking at all of their capital options, whether that's equity, whether it's debt, whether it's private, whether it's public, whether it's in the US or Canada. And we are one option for raising capital that should be considered. Again, not right for all companies to go public, not right for all US companies to go public in Canada, but it might be the right option for you that you had not even thought about. So again, the true value proposition is coming to TSX Venture, graduating up to Toronto Stock Exchange, and then when you're ready and relevant, dual listing into NASDAQ or NYSE. So that should be the goal of the company, to get to a senior US exchange. And we are one path to get there that may not be thought about, that I would encourage founders to at least explore.
Okay, and then Delilah, you said that the website is us.tsx.com?
Yes.
Okay, so that's where they can go see those requirements and know for themselves what they really will need to have and be prepared for.
And they can also reach out to me through that platform, or if they're in one of the other regions, if they're in the Midwest and Chicago area, to reach out to George, or Eric is in Dallas, so in Texas. If you're sort of west half of the US, then sort of reach out to me. But yeah, people can also reach out to me on LinkedIn, is probably the easiest thing. Or I can give my email if you want to put that in the notes as well.
Whatever means you prefer people contact you at. So we'll put your contact information in the show notes, of course.
Yeah.
Should they reach you then through email, LinkedIn?
Yeah, email is definitely email, yes.
And what is your email address?
So Delilah, DELILAH.Panio, PANIO @TMX.com.
Okay, so Delilah, DELILAH.Panio, PANIO @TMX.com.
Yes.
Okay, good. So we'll put that email address there. We'll put the address of the us.tsx.com as well. And then you said also through LinkedIn, people can look you up and reach out to you there as well.
Yes.
And then one last question. So you've got someone in Texas, someone in Chicago, And you in beautiful Southern California. How did you get Southern California?
Well, I was actually already living in LA when TSX decided to put somebody in market. And so it just worked out really, because I worked for TSX in Toronto for 10 years. And then I moved out to LA to do other things. And then I've been in market for the last 5 years in Southern California.
Okay, fantastic. Fantastic.
Yeah.
Delilah, so much. Thank you so much for the time today. We'll put your contact information there. And people who have heard the conversation and think they should have a conversation with you, don't know how to reach out to you, and hopefully some will.
Yes, perfectly. Thank you so much for having me on today. It's been such a pleasure.
Great. Thank you. Thinking of exiting your business? You may have only one chance to get this sale right. Your family depends on it. Come hear experts who plan and negotiate successful business exits for a living. Bring your questions. Live panel discussion followed by Q&A. Join us Thursday, April 27th, 2023 at the next Scottsdale Founders Forum, a biannual live event for the founder considering exiting in the next 5 years. More information available at scottsdalefoundersforum.com.